Good day, everybody. Welcome to the 2023 Economic Outlook discussion. Today's discussion is a product of the partnership between the U.S. Small Business Administration, Office of International Trade, and our friends at BAFT. And it is an amazing opportunity to discuss with you all today what we believe is going to be happening in our economy going forward in 2023. We have close to 1,500 registrants and participants today on the call and the webinar. I will remind everybody that it is closed to the press. But today's discussion is a product of the relationship between the SBA and BAFT. Part of our shared mission together is to understand and ultimately to close the trade finance gap. Part of this understanding is to root you all in some important statistics about the size and the character of the marketplace. So before we get into our discussion, and before I introduce Todd, I just wanted to share a few statistics with you. The first is that there are 33.5 million small businesses in the United States. This is a large and growing number and an important part of the economy. But 80% of those 33.5 million small businesses are sole proprietors, one person. And so when we think about the dynamics of the economy, the dynamics of the small business marketplace, let's remember there are many people, millions, 24, 25 million individuals who are running businesses. 5 million people started a business in this last year. This is the second year in a row. The president just announced this in the last couple of days. 5 million new business starts in 2022, coming on the heels of 5.1 million new business starts in 2021. And so you can see the momentum in the entrepreneurial world and the startup world is strong and growing. Finally, as is important to so many of us, and particularly us at the Office of International Trade, the number of small businesses who are exporting, who are engaged in international trade, is also relatively small but growing. We want to understand this number. The number that the U.S. Census Bureau publishes is 300,000 small businesses that are exporting. We actually believe that this number is an undercount of the actual size, let alone the potential size, but the actual size of the exporting small business marketplace. We believe this is an undercount for a few reasons. First of all, the Census Bureau has a great view as to the products that are being shipped around the world, both on airplanes and in ships. They have great insight into this. What they miss is the number of products and packages that are less than $2,500 in value. They're just too few and too small. And so while this is less common in the shipping container world, it is more common in the airplane package world, where a small business that is exporting might have a package full of goods that are worth $100 or $200 or $500, send that overseas, that is not getting counted. Similarly, service exports, be they an engineer or a consultant or a psychologist or an accountant, those people who are spending their time in intellectual property, service exports, in addition to service as a software as a service, are also not counted as robustly. That is survey data, not actual count data. And so for both of these reasons, we believe that the number 300,000 small businesses who are exporting is an undercount. We have actually commissioned some research in the Office of International Trade to better understand what the actual number is and what the potential marketplace looks like. And we will be rolling out the results of this research in the next several weeks. But I can tell you today that the number is much higher than 300,000 and a much more robust market than we're currently reporting. So as we have our discussion today on the 2023 economic outlook, in understanding the trade finance gap and what we can do about it, let's be rooted in these numbers. 33.5 million small businesses in the United States, 80% of which are sole proprietors, 5 million new business starts, and far more than 300,000 small businesses who are exporting. All right, In order to conduct our conversation today and to introduce our guests, I would like to pass the baton over to my friend and our partner at BAFT, the president and CEO of the organization, Todd Burwell. Todd, if
Thank you so much, Gabe.
come on screen and you can take it away.
Thanks so much, and I'm delighted to be here. Thank you to you, and thank you to all of our friends at SBA, and also want to welcome the audience and thank you for spending time with us. I just thought it made sense first to level set who we are and what we do, because there may be many of you that are unsure of what is a BAFT. So BAFT is an industry association that was founded in 1921, the Bankers Association for Finance and Trade, and our specific mission is really focused on international trade, cross-border payments, and liquidity. There's four fundamental things that we do. One is we promote thought leadership and best practices across the industry. The second is we conduct advocacy on behalf of the industry. We provide education and training, and what we call building a global community, which of course includes partners like the Small Business Administration and its partnership base as well. So as we came into 2023, there were a wide variety of priorities that we had at the top of our list. I thought I'd just share some of them with you and put this in perspective. Sustainability is clearly one, and the implications of sustainability on global trade are distinctly different than sustainability from a broad sustainable finance perspective. So that's going to be one of the large ones. Trade digitalization is certainly another large one that will have multiple streams. We're also going to be focused on various elements of financial crime, including trade-based money laundering and fraud, de-risking. We have the implementation of Basel III and the implications on capital requirements. We'll be closing out some work on supply chain finance accounting disclosure rules, which were put forth by the FASB last year. We'll be trying to address the unevenness in global payments regulation, looking at the implications of central bank digital currency, and then also continuing our investment in human capital and talent development for the industry. But perhaps the one that is most relevant to our partnership with the SBA is focused on financial inclusion in trade and trying to address this persistent 1.8 trillion trade finance gap. So we're currently participating in an industry-wide initiative that's called Financial Inclusion in Trade, or FIT for short, that was initially launched by the World Trade Board, but includes stakeholder organizations from both the business sector as well as the banking sector. It includes multilateral development organizations, industry bodies like ourselves. And the purpose of pulling these groups together is, number one, to develop a roadmap for sustainable and inclusive trade and finance for SMEs and MSMEs, which this roadmap, it's intended to outline the actions, the policies, the technology scaling, all of those things that are required to realize this vision of financial inclusion for MSMEs in the global trade and digital economy. And the roadmap will try to address things like identity, things like digital readiness, as well as the credit decision process. The second piece of that is going to be to actually engage with policymakers, with the industry, with finance providers, and other stakeholders who are positioned to actually address this financial inclusion gap. And so we're looking to hopefully have a draft of that roadmap by the end of the first quarter, the beginning of the second quarter, and then start to polish it and work from there. So you can see how that particular issue feeds directly into why our partnership between BAFT and the Small Business Administration is so important, and we're looking forward to the work that we can do together to try to help address this issue. So hopefully that gives a bit of a framework of what we are trying to do, why we're here, what we're focused on. But I think today's discussion is intended to talk primarily about the global economy and about the U.S. economy over the next year. And so I'd like to bring in our guest speaker for today, Sai Srinivasan. Sai is the chief economist and the head of research at the American Bankers Association. And I wanted to, just before I start to pose questions to Sai, is to invite all of you in the audience. You can also pose questions in the Q&A feature through the webinar platform. And we'll try to come to those questions at the end of our discussion. So with that, welcome, Sai. Thanks. It's great to have you here and joining us.
Thanks, Todd. It's a pleasure to be here this afternoon with all of you. I was actually thinking, it's my introduction to the world of banking was helping my dad deal with his banking solutions. My dad used to run this very small shop out of the suburbs of Mumbai, and all his stuff used to get exported. And I remember going to the bank and dealing with letters of credit and overdraft and lines of credit and so on and so forth. So I learned my introduction to the world of banking was from trade finance for a very small businessman.
Trade finance is the oil to the engine of commerce. That's
Absolutely.
what we like to say. So let's, if I may, sort of skip past the foreplay, and I want to kind of get right to the main area of interest that I'm sure everyone wants to know, which is around the economic outlook for 2023. And so I think over the last year, we've heard from a variety of CEOs from corporations and from banks. There's different views. Quite recently at Davos, the World Economic Forum reported that 2/3 of private and public sector chief economists that they surveyed expected a global recession this year. And I think they said 18% consider it extremely likely. So I really want to get your thoughts on 2023, and maybe there's kind of four big themes I'll ask you to consider. One is inflation, one is employment, one is interest rates, and then perhaps the last is the likelihood and severity of a recession.
Cool. So awesome questions. A good way to start off. So let's start with, I'll jump around, but, there is a common theme across all of it. So with inflation, everybody knows where we are today relative to the sort of the high inflation rates that we've been experiencing through late 2021 and all of 2022. But clearly inflation is in a downtrend. So, and I should also preface, a lot of my comments are going to be focused on the US, but every now and then I'll talk about what we're seeing from sort of the rest of the world also, right? So, so unless I sort of specifically, sort of flag it, my comments are going to be in the context of the US economy. There's a challenge with sort of looking at data, because the data is always backward looking, and what folks want to understand is what's going to be coming down the pike in terms of the next print. So this is what we know in terms of what's happening with inflation. The Fed has been working very, very aggressively in terms of increasing its policy rates in an unprecedented manner, right? 75 basis point, one after the other sort of a hike. We've never seen anything like that. And those things really have an impact. So where we are today is that all the signs are pointing towards inflation pressures coming down, right? So, and you're going to be seeing that in consecutive prints. There are also some challenges in terms of the CPI number that gets published. And so there is a component called rental prices, which have a 1-year lag and so on and so forth. But this time next year, the consensus among economists, macroeconomists, and others is that we are going to be closer to where the Fed would like us to be. So the Fed likes to target a 2% inflation target from a sort of long-term average perspective. And my view is sort of consistent with what we're hearing from other economists is at this time next year, we might be, below 3%. I won't say we're going to be close to 2%, but we're actually going to be somewhere in the sub 3% range. A big caveat to all of it is, this is based on what we know today. There's this thing called China, which is just coming out of the sort of its crazy zero COVID policy, and the risk that we face from in terms of the rosy inflation forecast is that if the Chinese economy comes back in a big way, then you're going to see commodity prices go through the roof again. We have been, if you look at the commodity prices, energy prices, and others, they have still been low because the expectation is that the world economy is going to be in a recession and so on and so forth. So demand is going to be low. But we don't know where China will, how things will play out in China. But based on the information we have, I think in terms of inflationary expectations, I think it's all on a downtrend, and a lot of it is because of what the Fed is doing, the supply chain issues that we were dealing with during the pandemic. Those have been resolved, at least from a headline perspective. So a lot of the pressures in terms of inflationary pressures we're still seeing are from the demand side and from the consumption side, and that is also being addressed. That's also getting impacted by what the Fed has been doing. In terms of rates, I'll talk about rates and then I'll come to employment and recession. So in terms of interest rates, if you think about the headline number, the Fed funds rate, there's economists fall in sort of two camps. One who believe that the Fed has signaled that it will take the Fed fund policy rate to say about 5%, and after that they will stop, and depending on how the economy is going, they might actually start easing on it. Then the expectation is that they will start cutting the policy rate. There is another camp which believes that because the labor market is so strong, if you really want to hurt demand, the sort of the demand pressures in the economy, the Fed will have to raise rates much higher than where it is, the 5%. Even then, they're talking about taking it from 5 to 5.5, but nothing more than that. The more important thing than the policy rate is the 10-year rate and the treasury rate, which is what, we think about mortgages, and a lot of business loans and others are priced based off the 10-year treasury. The expectation is that it's going to be in the 3.5–4% range, or even less than that. There is the sort of the joker out here, which is what's happening in the US in terms of the sort of the politics we're dealing with in terms of the ability of the government to continue funding itself and so on and so forth. So, but assuming that gets played out in a sort of a sensible manner, the expectation is that you're not going to see the 10-year rate shooting up. It's going to be in the sort of the 3.5% range, which is, from a long-term perspective, that's like a good place to be in. So coming to employment and recession, and I'll sort of jump back and forth. In terms of recession, for the longest time meaning for the past year and a half, when people ask me this question, what do you think, is the US economy going to be in a recession? I shamelessly ask them, can you define recession to me? We had 2 quarters when the GDP dropped. The view was that it was more like an accounting in a recession, because when we sort of lay human beings think about recession, we think about huge unemployment in the marketplace, right? Severe drop in GDP and lots of people getting laid off. What we're seeing now is that the labor market is just incredibly strong. The economists don't see signs of any of that getting eased in any sense. So from a labor market perspective, we think in terms of demand and supply. we're not having any supply coming in because of immigration issues and so on and so forth. Women in the workforce not able to work because childcare is expensive and so on and so forth. Nothing is easing from, there's no supply coming into the US on the labor market side. So what you have to give is on the demand side. And the signs we're seeing is that firms are continuing to hoard employees because they had a tough time getting people, and now they're realizing that they have faced with economic uncertainties. I'm not sure what's going to happen to my business and my revenue during 2023, but I'm still going to hold on to my staff because I don't want to let people go and then struggle to sort of go and hire them back. So there is this, we haven't seen it much in the data, but there is, everybody speak to talks about this hoarding which is going on. So they're not laying off people. There are still jobs available if you want, despite what you're reading in terms of the big tech firms laying off folks. They're all well qualified people, and there's still, the countries continue to invest in technology and so on and so forth. So the labor market is a mystery to people in terms of how that will resolve itself, how it will play off. So from an employment perspective, everybody knows that for the Fed policy rates to have their impact, the unemployment rate has to go up. It's at 3.75% now. It needs to go up to somewhere closer to 5%. But I personally don't have a good view into the path of travel from where we are to that higher rate, I guess. So the labor market is a mystery. So that sort of gets us to the recession. There's going to be a slowdown in economic activity, and you sort of quoted the survey responses. I think 18% seems to be a very small rate. I've seen other seminars and other polls where professional economists have been coming up with a much bigger number. I would put economists as being generally split, at least the ones I've spoken to, and where they differ is the median tends to be close to zero, that you're going to be seeing no GDP growth. There are some who think there will be a small drop, and some who think we'll be like at a 1% GDP growth, which for me is pretty close to sort of zero from a sort of a real perspective. So that's like, there's a slowdown in economic activity that's happening. Prices are coming down. It's the job market is tight, but it will start weakening at some point. We don't have a good sense for how it will weaken. Interest rates are also on the way down. And so that's where we are. I think the Fed has sort of the US economy at a spot where it should be feeling comfortable in some sense. So I'll pause here. Any sort of follow-up questions?
Yeah, so you did a great job of covering a lot of ground. If you don't mind, I actually want to ask you, and maybe this is a little more of a personal question, because one of the points that you talked about was the labor market. And from a non-economist point of view, it strikes me that we are in such an unconventional type of labor market. And I wonder if for economists, if you have to completely reconfigure your modeling and your thoughts about how does employment fit into all of your other models. What are your thoughts? Have we seen a fundamental shift in what employment is going to look like?
So there is a broad consensus among economists that, just as you sort of step back, you spoke about models, the classic models that economists have been using, macroeconomists have been using to predict what's happening to the economy and business cycles. They will all say very openly that all those models need to be thrown out of the window, and they're all busy. Even the Fed and all the central banks are sort of rejigging the models, right? So there's been a fundamental, acceptance that the models are all broken, they need to be tweaked. In terms of the labor market, everybody agrees that behavior has changed. The data point that Gabe was quoting earlier in terms of large numbers of sort of, the 5 million new, small businesses that have been opened, it's very clear that a lot of people have realized that it's very expensive So let me sort of phrase it in terms of how economists think about it, right? So there is a cost of everybody needs to earn a living, right? And there's a cost of being in the labor market, right? What the pandemic has done is that it's changed the considerations in terms of the cost of what price am I willing to pay to earn what was buck that I'm interested in earning, right? So if I was in certain businesses like teaching and healthcare and childcare and others, there's a realization the risk is very high, right? And you're not paid enough to sort of deal with that burden. So in terms of the trade-off, folks have said, you know what, I'll quit this job and go do something else. I'll change my line of profession. Right, and you're not going to be getting paid more to be a teacher because there's a cap on how much, right? So that's been a sort of a change. Living in expensive cities, and we live in one, expensive metro areas with what's happening in the housing market and so on and so forth. The situation that do I really, if some of us have been fortunate that we can telecommute, but not everybody from home, right? So there's been an outflow, and I think you're going to see more in the data of people moving away from bigger cities into sort of more rural areas. And when you go there, I'll take up a low-paying job, but if my cost of commuting and rentals and everything else is much lower, so my take-home pay can be higher than what it was if I was sort of living in the city, or start a new job and so on and so forth. So I think that the trade-off in terms of being in the labor market, the cost of the price of being employed, that's changing. And I think the one question which we don't have a good answer on is what's happening to productivity through all of these changes. And I think for the audience, businesses and others, they're all interested in how is all this impacting productivity. And unfortunately, I think economists don't have a good sense for where we are on that. At the end of the day, that's what matters, right?
Right. And I think we're all, especially in some of these hybrid working arrangements, we're still trying to learn how to be productive. So I imagine that's going to change over time as well. I wanted to pivot, if we could, and take a look at the implications on trade, right? Sure. So if we look at some of the WTO forecasts, trade volumes, I think initially their forecast was about 3%. They're now expecting 2022 will end with about 3.5% growth. But broadly speaking, they anticipate 2023 to be about 1% growth. The good news is that it's still growth, but obviously it's flat. So I wonder what your thoughts are vis-a-vis things like the strength of the dollar. I know you alluded to supply chains perhaps normalizing. What's your outlook on those things as they affect trade?
Right. So I think when I think about the forecast, and I was asked to come up with these numbers. Fortunately, you guys don't ask me to do that stuff. But I will land. My forecast would be very similar, and I think the models are being driven by the forecast of what's going to be happening to global GDP in some sense, right? Expecting a slowdown here in the U.S. In Europe, they're already having a slowdown, and many emerging markets around the world, there is a sort of slowdown that's happening. So the world is already in sort of a recession of sorts, depending on where you're located. So that means trade has to sort of that gets reflected in the international trade numbers. In terms of the strength of the dollar, and then I'll talk about the supply chain because it can be a longer conversation and you can cut me off. The strength of the dollar it matters a lot, and it's when I speak to businesses and banks who are sort of exporting here from the U.S. The strength of the dollar is of concern to us, and my personal view is that we might have seen the top of the dollar because some of the strength that we saw in the dollar during 2022 was driven by the Fed moving aggressively in terms of raising its policy rates. As the Fed sort of slows down, the pace at which it's hiking, and you're going to see, less of more of a headwind for the dollar in some sense. So it's reasonable to expect that the dollar is going to remain. It's going to be not as strong as what we have seen during 2022. So, and in terms of how it impacts people, it depends on what's happening to crude oil prices and so on and so forth. But the strong dollar has been an impact, and to the extent it sort of stays flat or comes down a bit, it will sort of it will be helpful for folks in the rest of the world. In terms of global supply chain, it's a $1 million question. I personally worry about the impact of the zero COVID policy in China and the ability for firms to sort of continue doing business with China. Things have been moving along, but at some point you need to travel, you need to see your supplier, and so on and so forth. That still is sort of a risky proposition. We're going to have consequences to what we have been seeing, and I'm not anticipating that there'll be a quick shift in sort of the global supply chain. What has happened, what the pandemic has done is it has made businesses small and large really aware of what you call the risks and the resilience or the lack of resilience in the global supply chain, right, in their individual supply chain. I've spoken, the smallest of businesses are looking very carefully at, their own individual supply chains and what are sort of the risk factors and what are the mitigants that they can be taking, steps they can be taking, sort of mitigate the risk, I guess. So do I anticipate a major shift in sort of global sort of trade patterns over the next couple of years? No, but over a longer period, you're going to see firms taking steps. There'll be nearshoring, looking at other countries, other suppliers. But a consequence of all of that is if you believe that the global supply chain and just-in-time and everything else help keep prices low, if you move to a more resilient model, you're going to see sort of prices being slightly higher, which will actually be an inflationary pressure in some sense.
Yeah.
But so that's like, I think the major issues are being resolved, but sort of from a longer term perspective, I think you're going to see more sort of, we'll be transitioning to a different equilibrium, and that's sort of expected.
Yeah. So one of the words that you used earlier was you talked about the Joker. And I think in any discussion that I've had, not just an economic discussion, but a strategic discussion or anything, the wild card is always geopolitical issues that ultimately clear the decks and cause everything to come anew. Now, certainly the reemergence of China from their zero COVID, any impact on the war in Ukraine, oil prices, or one of many other things that may be going on in the world. What are the things that perhaps you think should concern everyone the most? And how do you see these things playing out?
What we kept hearing from folks through all of 2021 and especially in 2022 was the madness in the energy markets, right? It impacted everybody from farmers to small businesses, right? It impacts everybody, and a lot of it was triggered by the Russian invasion of Ukraine. It's not clear sitting where we are today as to how that's going to play out. You will talk. There is a lot of war gaming that's happening in terms of how the Russia-Ukraine thing will play out. There's a lot of uncertainties about what President Putin will do. There are very sensitive, smart folks who are sort of paid to think about the risk factors, are very seriously thinking about nuclear. Russia is a large country, they've got nuclear arms, and can they use some of that sort of threat and in terms of the global the gaming that happens in geopolitics. I don't expect things to fundamentally change. It's just that there will be this you'll continue to be the instability in this market and uncertainty in this market, which businesses don't like. I think businesses and banks and others, as long as prices are at a certain level, they find what everybody struggles with is uncertainty, right? So the Russia-Ukraine thing remains a source of uncertainty, and you'll see that manifest in crude oil prices, energy prices, and the U.S. is sort of in a good shape because we are economically independent in terms of crude, but not necessarily some of the byproducts which still need to come from other countries in the world. And to the extent our trading partners in Europe are still struggling with it, it will remain an issue. But if you look at what happened in Germany, they worked really quickly and efficiently to sort of be able to sort of accept imports of LPG and others from the US. So I've been more worried about the sort of the geopolitical risks and manifesting in the form of higher commodity prices, and then China is a big issue. There are some folks who worry about China and Taiwan and how what might happen there. So top two, Russia, Ukraine, and then China, Taiwan. It's not very sexy to talk about it, but from a risk perspective, a little bit about that.
Yeah, well, but it's important to understand we live in a connected world, right? And certainly, I think it's very relevant for many of the small businesses and the banks that serve them, which kind of brings me to the next set of questions, which is we've talked about sort of the broad economic outlook and the outlook for trade, but we know from historical purposes that during difficult economic times, small businesses oftentimes suffer more than large companies. And so I'm interested in your outlook for small businesses for 2023, including their access to capital. And let's extend that to banks as well. How do you see things playing out for smaller regional and community banks?
Right. It's a good question. And as you know, at ABA, we spend a lot of time talking to small banks, and they tend to be the main source of funding to small businesses. And we saw that during the pandemic, the PPP program and others, when small community banks in the US did a huge amount of work to help small businesses in the US. The good news is that from the perspective of availability of liquidity, sort of for banks to lend money and fund small businesses, the U.S. economy is in a wonderful place. The financial system and the banking system is in a wonderful place. In other sort of crisis situations and recessions, we entered the economy with businesses, the financial system really facing very tight liquidity conditions. In this time around, actually, because of the QE and the stimulus programs from the Fed and this change in sort of consumption behaviors, the financial system is still is very healthy liquidity. In small banks I speak to, they still have very healthy deposits and sort of low loan to deposit ratios. So the banking system, from sort of a broad perspective, is well situated to continue helping small businesses with their sort of funding needs. From the perspective of small businesses also, and once again, this is a spectrum. So what I'm saying is just in terms of an average, right, to the extent an average exists. There are many small businesses realize that they need to do a better job managing the sources of liquidity during the pandemic, right? And good practices have been developed. And what we are seeing when we sort of, what we hear from small businesses and also especially the banks who speak to small businesses is that they're all dealing with the headwinds, but there is still this robust economy. The thing which a lot of small businesses complain about most is the challenge in terms of hiring staff than in access to finance. Nobody complains about access to finance. Nobody is complaining about rates going up, because that is all signaled and people understand that's bound to happen. So so just because of the fact that there's going to be economic slowdown and there'll be more sort of headwinds to the economy and for small businesses, From a funding perspective, a source of liquidity perspective, I'm not too worried about it. I think the banks and others are well situated. And the banks themselves are very well capitalized because there are all rules and regulations and good risk management and so on and so forth. So the financial system is very healthy. The banking system, the community banks are very healthy to continue sort of supporting small businesses.
Yeah. So I think I heard a little bit of good news in there. I think
Yes.
I did. And so maybe just before I invite Gabe to come back to see if the audience has questions, perhaps my last question is to go back to the original comments. We started talking about this trade finance gap, and over the last few years, we in the industry have seen that gap continue to grow. But this business oftentimes can be countercyclical in nature. And so I'm curious on your thoughts with the economic outlook that you're anticipating. Do you think that this gap is going to continue to grow this year, or are we likely to see more small businesses perhaps turning to trade as a means to expand in this economy, and perhaps the gap will shrink?
I don't have there isn't good data about trade finance, and we economists really struggle with that. And I think we should do a better job from an industry perspective of capturing that. But when I speak to banks about it, what I keep hearing from them is they just continue to invest. They're looking for ways to innovate. There is a lot of talk of innovation in this space. They are realizing that supply chains matter, because trade finance and supply chains sort of go hand in hand. So there is higher sensitivity to sort of risk, but banks are in the business of managing risk, right? So the quick answer to the question, Todd, is that I don't see any headwinds from that perspective. So it's going to be some extraneous factors rather than a lack of appetite from the banking industry perspective. And also, small businesses, as I was saying earlier, they just become much more smarter in terms of managing their sources of liquidity, and being very opportunistic, especially in a rising rate environment. So my bet is that the numbers don't reveal everything that's happening, but there is a strong focus on getting some efficient funding from whatever sources available out there.
Yeah. And so maybe I'll just take a bit of personal privilege and do a little bit of commercial as well, which is to really just encourage, if there are small businesses or small banks that are listening to the webinar that have started recently, or perhaps are considering expanding their international trade. Maybe they've been looking at domestic supply chains, and I know that there's been a lot of talk about nearshoring and so forth. I do think that trade has continued to show that it can be an economic opportunity, in particular for small businesses. And I think so goes small businesses, so goes our economy. And so, those of us in the industry, we like to say the water's warm, come on in. And I think organizations like BAFT and organizations like SBA are really trying to focus on removing some of the obstacles to allow us to help businesses grow through the use of trade. So I also want to kind of end on a high note and an encouraging note. But I would like to invite Gabe to come on back in, because I'm sure that we have quite a few questions that have come in from the audience, and I don't want to hog the stage, and perhaps Saeed can take some of the audience questions.
Absolutely. Thank you both for the great discussion. Let's continue with some of the questions that have come in, and let's just jump on a technology one. Dr. Srinivasan, you had mentioned innovation in your last comments. Talk to us about the role of technology in trade relative to two aspects. One is access to capital, namely how technology might be improving the back office portion of Know Your Customer and Patriot Act checks and all the other checks that we need to do, number one. And then second is with respect to the facilitation of trade itself on the customs side, digital asset tracking, blockchain in trade, any of those things in terms of how technology is impacting both finance and trade facilitation itself.
Right. So awesome questions, and we just have good news on both fronts, right? The one sort of key sort of takeaway from the whole sort of PPP funding. People highlight some of the challenges, but every program has challenges. But the sort of huge sort of change in behavior that we've seen across businesses, banks, and the whole sort of the funding sort of chain, I guess, supply chain there is the adoption of technology. And I speak to small banks and around the country, and everybody has learned so much from that experience. And even as past few years, you've seen banks investing more resources into be able to use digital technologies, not from a sort of crypto perspective or not even from a blockchain, but just using remote technologies to be able to service small businesses around the country, not just in their communities, but also around the country. So and ABA has we hold multiple conferences during the year focused on small businesses and helping them serve the small businesses as small banks and small businesses, and you sort of walk around sort of the trade show that happens. There are all sorts of vendors coming up with new technologies and new services to help banks with a lot of the back office things, right? And then on the adoption of blockchain and other technologies, I was at a conference, the ABA Ag Lender Conference in Omaha, Nebraska, late last year, and there were a bunch of vendors who were talking about using blockchain technologies to help the farm community. Right, so you have the cattle and sort of they tag the year of the cattle, and they're having sort of blockchain technology embedded in those things. So at the grassroots level, there's a lot of innovation happening, and focusing on businesses of all shapes and sizes. And then even from international trade, there are some very interesting use cases happening, and Todd and BAFT have been holding conferences where some of these things get discussed by some of the largest banks. Looking at trades in various goods and commodities and how to introduce. I think it's all in experimental stages now, but people are spending a lot of time and effort, and they're not distracted by the blow up you're seeing in the crypto land, because they think there are some serious values to be gained out here and innovation to be had. Not just, as I said, from the farming and cattle businesses to the more sort of humdrum international trade stuff. My belief is over the next 3 to 5 years, you're going to be seeing the, you not see headlines, because international trade is not sexy, and we like to keep it that way in some sense.
Well, it's interesting. Even in our own travels around the world, we see that, and we have evidence that FedEx, UPS, DHL, the sort of air shipment component of trade, is adopting digital technology quite well. It is the cargo shipping that is still running a little bit behind and still very paper-based. And of course, our hope is that technology, blockchain in particular, just asset tracking, will be able to improve the efficiency of those industries in a quicker pace. And hopefully, as a part of government, we can help push that along a little bit.
So Gabe, if I may, before you jump to the next, because I also like to give homework to people. It's, it's the years of teacher in me. Blockchain can be a really, really big, massive undertaking. And so I'd like to ask your audience to look at two things in particular, which I think they can do to help move this journey along. One is a legal entity identifier. This is very, very important in helping to solve for one component of digitalization, which is who are you? and that allows for entities to better communicate information about the parties involved in trade. The second is e-invoicing. I think when we look at digitizing all of the aspects of data, the invoice probably has the biggest impact in terms of all the data or all of the documents that we would like to see digitized, and it opens up a lot more opportunities. So I would say initially focus on those two, and then we can build out from there.
Excellent. I'm going to return to one question on inflation that came up from the audience, Doctor, which is that we've seen, despite what trade would teach us about competitive advantage, localizing resources where most effective around the world, we've seen that there's this effort and influx of manufacturing back to the United States, whether it's onshoring and whether these are organic processes or it's sort of government incentives spurring US manufacturing. But what we found as a result of which, of course, is that that's not necessarily ever going to be the low-cost provider in the United States. And therefore, there is potential for upward pressure on inflation because of energy and labor costs associated with US manufacturing versus lower cost overseas manufacturing. So does this worry you? And how do we strike that balance between wanting to ensure the validity of our supply chains locally here in the United States without compromising on the inflation pressure?
Yeah, so it's a good question, and it's a very the considerations are very complex. And you can see it through the lens of the T-shirt, right? You can go to Walmart and you can get a T-shirt for $6 or $7, depending on. I always look for 100% cotton. I increasingly struggle to find a T-shirt for less than $10, which is 100% cotton, right? So they sort of blended with whatever, and But I look at my closet and it's full of these, cheap T-shirts I've bought over a long period of time. And why did I buy it? Because it was just less than $10, so I just kept buying it, right? So if all these T-shirts that I have in my closet were all made in the United States, I'd have been paying $25, $30 per T-shirt, and I would be having 40 different T-shirts in my closet, right? So I think there should be. So it's a question of the Walmarts of the world and the American consumer and the preferences in terms of how many T-shirts they would like to have and so on and so forth. But you see the tension that's there, right? In terms of consumer preferences, large businesses being incentivized to sort of feed that the interest in consuming, and then going all around the world to find the cheapest sources of supply. If they realize, but even like without going that far, what we know is, China has been a great source of, low cost as a supply for a while now, and all the gains were coming from cheap labor. And as we have been reading in the past few weeks, there's a population slowdown in China. So it's no longer going to be the source of low-cost supply, and at least from a labor perspective. So what you're going to see happening, I think it's inevitable that prices are going to go up, and then it's a question of how will consumption change. But my bet, Gabe, is with human ingenuity. People will figure out ways to use technology in a much more efficient manner. But as long as folks are focusing on the resilience of the supply chain, I think we should land in a good place, I guess. I'm not too worried about it.
And maybe it is sort of custom manufacturing comes back more robustly in the United States, but sort of the mass market manufacturing where cost efficiency is the critical factor remains overseas for a while. But we'll see how that balance plays out. Todd, this is actually one for you, and maybe we'll try to wrap a little bit on this one, which is when we think about the banking sector and the role of banks in trade finance. Obviously, there's a split between community and regional banks and then the big behemoth bank. But we're always interested in financial inclusion and making sure that the broadest sector of the economy has access to capital. And I know this is a lot of the work of BAFT in promoting these efforts. So talk to us about the role of community and regional banks in promoting financial inclusion and perhaps a focus on the small business export marketplace. How do you see that sector evolving and being a primary driver of the marketplace?
Yeah, so I think that there's a couple of elements. One is who is the client and who best is positioned to serve them. And at the risk of perhaps my large members not being so happy to hear this, I do think that smaller banks and regional banks oftentimes are in a better position to serve those small businesses. They understand who the company is. They understand the parameters within which they're working. And so there is clearly a role to play for smaller banks in this trade space. The challenge that they often have is the expertise to be willing to undertake the risk associated with doing international business. And so I think that's where organizations like the SBA, like BAFT, and like larger banks that have the institutional knowledge of international markets can work as partners to help those banks. So I really don't see community banks as competing with large global banks in that regard, but really working almost as an extension where the community bank's relationship with the larger global bank is such that it becomes a channel. It's a channel for the small business to enter that market and to connect to the rest of the world.
I would concur with that. And I know, Dr. Srinivasan, you have a comment on that as well?
Yeah, so a couple of things. One is just in terms of banks, ABA has got various initiatives. We have the Minority Development Institutions Council, and one of the initiatives under that council is to help partner small banks with larger banks, right? Because larger banks, as Todd was saying, they have the strengths in terms of global outreach and others, and smaller banks have sort of the local knowledge and the sort of the local relationships. So there's a huge initiative on the way to sort of do more of the pairing and sort of relationship building. And in terms of financial inclusion more broadly, I'd just like to sort of do a plug for the Bank On product. So the Bank On is basically a certification by the CFE Foundation, which is a no-cost bank account with no overdraft, no fees, no nothing. You get an ATM card and you get a checkbook. So that's like been a huge initiative at the ABA and the banking industry, and we actually have information available on the ABA website, which lets you map around the country and say which are the banks that are offering the Bank On. And I think about 95% of the US is covered by banks and branches which are offering sort of the low-cost banking account. Huge initiative to sort of help the access to banking and a low-cost checking and savings account product.
Perfect.
Yeah, and as a complement to that within BAFT, so our members are headquartered in 65 countries around the world, and so we have the largest of the large banks certainly within the US, but then we've also got another 45 to 50 regional banks within the US. But we've recently launched what we call our Global Regional Banks Council, where we have banks that are located in sub-Saharan Africa or the Middle East or in Asia that are smaller than those large global banks that know their markets within those specific countries and may not necessarily know the smaller banks that sit, let's say, within the US or within Europe. And their relationships just between the banks always go through a global correspondent. And what we're trying to do is also provide the connectivity for those banking relationships between the smaller banks in different countries so to help facilitate more direct business.
Perfect. Perfect. All right. I think we've come to the top of the hour and the end of our discussion. Todd, let me thank you for your partnership and for being a host in the conversation with our good doctor today and Dr. Srinivasan. Thank you for sharing your insights with us and with the audience. For those of you who would like to find more information on any of these topics, this has been recorded and will be available after the fact. We'd like, of course, to get your feedback on today's discussion. And if you'd like more information from either the SBA or BAFT, you see the slide up in front of you. You can find information on the SBA, Office of International Trade, at sba.gov/international, or email us at international@sba.gov. And similarly for our friends at BAFT, info@baft.org or www.baft.org. Thank you again, everybody. Have a great year. We will be back in touch and see you again soon. Thanks so much.